Welcome to the Stonebridge video series. This is the Efficiency Drivers series. In this video, we will discuss the gross profit contribution and why it's important and what exactly is the optimal gross profit contribution for a business. Hi, my name is Dan O'Connell and I'm with Stonebridge Advisory. Our series is built around the 7 cash drivers of a business. The primary cash drivers are on the income statement, and the most important is sales, then the cost of goods sold, and last, the operating expenses. The result of these 3 cash drivers are the gross profit contribution and the operating income. The secondary cash drivers are on the balance sheet, and they are receivables, inventory, capital expenditures, and accounts payable. While all businesses may not have all 7 of the cash drivers, these cash drivers are the engine of most businesses. Because these cash drivers are based on how efficiently a company manages their own cash drivers, we call these the efficiency drivers. In this video, we want to concentrate on the gross profit contribution. We know the gross profit is after deducting the cost of goods sold from sales. The gross profit needs to contribute to the operating expenses and to a reasonable profit. The gross profit is impacted by the company's sales quality and the cost of goods sold margins, but also the gross profit can be influenced by a competitor and the company's position in the industry. The cost of goods sold is usually the company's largest expense. When reviewing a company's earnings potential, after sales, the gross margin is the second most important line on the income statement. The gross profit margin trend indicates how the company is controlling its largest cost and how outside economic forces are impacting the company. Companies make money by delivering a service or good with good cost controls. So the goal is to optimize the gross profit, which is done by growing sales and lowering the cost of goods to sales margin. In this exhibit, we have the sales increasing over the past 4 years. The cost of goods sold also have been increasing from $2.4 million to $3.8 million in 2018. The gross profit has been increasing also, but let's look further. The gross profit margin has gone from 61 to 58%, which is not good. It looks like 2016 was the optimal year for the gross profit margin, as it was 62%. Let's apply that 62% optimal gross profit margin across all the years, which we did in the red box. In 2018, the optimal gross profit was $5.58 million. The difference between the optimal gross profit and the historical gross profit is how much extra cost was in the cost of goods sold, which is in the red box. Last year, the company had excessive cost of $330,000 in its cost of goods sold, which was 4% of sales. This excessive cost reduced profit by the same amount. Let's move the excess cost of goods sold to the top and see to the extent these extra costs have impacted the company. If we applied a capitalization rate of 14% to the lost profit, in 2015 the company's value was reduced by $457,000. In 2017 it was $1.1 million, and in 2018 the company was worth $2.3 million less than if it were operating at optimal levels. The company lost an accumulated $554,000 over the past 4 years, and in 2018, for every dollar of extra cost, the company was devalued $7.14. Often, companies will have expenses outside of their control, like rising energy prices, for example, which will negatively impact the gross profit margin. But long term, the company needs to find solutions to overcome the challenges and know what their optimal gross profit margins should be. Companies need to maximize the gross profit contribution in order to cover operating expenses and to contribute a reasonable amount to profits. Profit is a result of good cost controls, and it begins with the gross profit contribution. Thanks for visiting with us today. If you want to learn more about Stonebridge, you can find us at www.stonebridgema.com. Also, the link below to more video series is at the bottom of the page. Thank you.